Coming up, a major software crash disrupts travel, trading, and banking across the globe in what could be the largest IT outage ever.
The disruptions adding to tech's troubles at the end of a week that's seen the NASDAQ shed more than 3%.
Plus, Trump outlines his America First policies while pressure mounts on Biden to bow out. Let's take a check of these markets right now on this Friday morning. It's been a long week. That outage that you're seeing, that global disruption, you're not seeing it in the futures right now. The S&P 500 currently up about 0.2%. Same thing if you take a look at the NASDAQ 100, up 0.2%, despite what we're seeing, of course, in CrowdStrike, in Microsoft. And then the bond market, a little bit of a sell-off underway, Matt. Currently, 10-year Treasury yields up about 3 basis points.
Right, and we have seen a sell-off all week, especially in tech stocks. Interesting to see the way investors are playing that. Rather than buying the dip in stocks, it looks like what they're doing is buying calls instead. You can see this chart goes all the way back to the beginning of the year, and the biggest call volume that we've seen over the last 3 sessions of big drops in tech stocks.
And bringing you back to take a look at those CrowdStrike shares. They're down as companies around the globe continue to be impacted by widespread outages. Pre-market CrowdStrike down more than 11%, almost 12%. Also down American Express and Halliburton. American Express down almost 2%. Halliburton down more than 4% after reporting earnings this morning. Netflix rebounding after last night's results initially had sent shares lower.
If you're just tuning in, welcome to Bloomberg Open Interest. We've seen outages grounding flights at American, Delta, United. We've seen airports ground to a halt. We've seen bank trades have trouble getting put through, and a lot of bankers actually just going home around the globe after this IT outage disrupted trade and business. Even 911 services in multiple states were down, with the U.S. Emergency Service Alert Services saying, please just call your local fire or police department directly.
The daisy chain here has been pretty staggering. I mean, you think about a single point of failure. That's what this feels like. And just watching the implications across industries has been staggering.
And even when things are improved here, you still have that issue of all those flights being canceled. Now people stuck in airports waiting to get the next one. This could be a little painful into the weekend, guys.
Yeah, I saw that 16,000 flights so far have been affected. Let's talk more about this with Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst. Mandeep, you cover some of the companies that are at the root of this problem. Microsoft, for instance, if you have a Microsoft Windows device that's connected to their network, or if you're using Azure cloud-based services, you could be having problems.
Yeah, and we knew, I mean, Microsoft obviously is pervasive. It's the operating system that a lot of companies uses. But CrowdStrike, you know, the fact that CrowdStrike rolled out a code update that could bring down the entire, you know, airline systems just goes to show how interconnected these environments are. And CrowdStrike, the good thing for them is it wasn't a cyber attack. It was an outage because of their own code changes, and they have rolled it back. So that, I think, makes it short-term in nature. But clearly, the fact that Windows functionality could be changed by another software provider rolling out an update raises a lot of questions here.
Yeah, and of course, to the point that it's not a cyber attack, that's probably good news there. But even still, talk to us about the reputational risk that this poses to a name like CrowdStrike.
Absolutely. I mean, CrowdStrike is perceived as the category leader when it comes to enterprise endpoint security. And they were one of the software companies that managed to grow over 30% over the past 3 years. So clearly, their valuations, you know, 20 times sales, it does raise a lot of concerns around the kind of the rollouts that they do and how they manage expectations going forward. Because for companies like this, it's all about the momentum in terms of signing up customers, deploying your software enterprise-wide. And this raises more questions.
One thing I did this morning was went through and tried to see which banks had exposure to Microsoft Cloud. They don't always disclose that so clearly. How interconnected is Microsoft Cloud to the rest of corporate America, frankly?
Yeah, so I mean, this outage was more geared towards Windows environments. So it's not really related to cloud, but it's more about the operating system. So even Amazon AWS customers that have Windows instances got affected. But clearly, Microsoft owns Windows, and the fact that their operating system is in question right now affects them more than, let's say, Google or an Amazon, because even though they run the instances, they're not the ones who have to protect the software as Microsoft has to in this case.
Mandeep, thanks very much. Mandeep Singh of Bloomberg Intelligence. You're going to be seeing a lot of him today. Also, keeping an eye on the airlines specifically as the IT disruption canceled more than 1,300 flights, delayed 16,000 globally. We're joined by Bloomberg senior global aviation reporter Sid Phillips. So, Sid, it's hard to keep track of all the problems. It seems that almost every airport has been affected because almost every airport and almost every airline uses Microsoft Windows devices.
Yeah, we've seen outages from New Delhi to Paris to Miami. Across the world, we've seen outages, and we've seen outages at airlines, including the U.S. carriers, the big three in the U.S., Delta, United, American, as well as carriers like Lufthansa, KLM, Indigo in India. So lots of outage, a lot of disruption, and the airlines are really going to have to struggle to get their schedules and get their flights back in order. Crews are going to be out of place. Aircraft are going to be out of place. And so for the airline industry, this is a huge blow, especially at a time when we're sort of getting into the peak summer travel season when airlines make all their money. And so this is peak season for them and huge blow for them.
All right, Sid Phillip, really appreciate that reporting. No, it's a very busy day for you. And you can continue to follow the latest updates on these outages by typing TLIV on your Bloomberg terminal. Now, earlier this month, Fed Chair Powell and ECB President Christine Lagarde were asked what they thought was the biggest risk to their economies. Here's how they responded.
We know how to deal with credit risk. We know how to deal with lots of kinds of risk, market dysfunction, things like that. But we haven't really had a big successful cyber attack on a financial market utility or a bank. And that's the kind of thing which I think is, the stuff of lying awake at night.
We need to constantly improve the level of coordination, first, second, third line of defense, and best way to respond to those.
We're joined now by Matt Miskin. He is John Hancock Investment Management Co-Chief Investment Strategist. And of course, this wasn't a cyber attack, but we are seeing mass outages here. So I'm going to ask you an impossible question, but what do you think that the economic impact of this could potentially look like?
Yeah, it is likely going to leave a dent in the quarterly earnings. Probably nothing too material, but enough. I mean, it's amazing what a day can do if you're already, on a razor's edge in terms of looking at earnings estimates or earnings to deliver for shareholders. I would also say, though, that likely the outcome of this is more tech CapEx. So you would think that they would actually take some, maybe have a lower price point or give you a deal based on this outage. Usually the way this works is you got to spend more. You got to spend more on the technology. You got to have diverse technology inputs, not to over rely on one system. And you've got to have more security to make sure that it's all working. Those companies that have that edge, that have that investment, are likely going to hold up through this volatility better. But it is likely more CapEx spending, not the other way around.
I mean, does it also create some dispersion in the way that you look at tech names? Of course, there's CrowdStrike, but there's also the giant name of Microsoft involved in what happened in this global outage. How do you think about what that means for winners and losers in this market?
Yeah, it's really been still a broader rally across tech, and the mega cap tech names have all been benefiting from just better CapEx. And, I think for this, it is a disruption. It just shows the breadth and depth of how much tech is involved in every single company. Names like Microsoft, this is a part of their business, obviously. The cloud's been a big part of their business. They've got a lot of other business units that are going to be holding up pretty well. But it is going to be a dent. And, again, there's a lot of optimism around the earnings for the rest of the year. Earnings estimates are looking for double-digit earnings growth out of tech. It's trading at nearly 31 times earnings. So it's priced for perfection here. And things like this can mean some volatility in the price. It can mean some, disruption in the earnings.
What we see, Matt, with problems affecting Microsoft Windows devices, disrupting, the entire globe's IT system, kind of reminds me of this stock market, right? If you have problems with NVIDIA or the chip makers, for instance, as we did the other day when the Biden administration floated the possibility of bigger problems for anybody sharing technology with China, it brings the whole market down. Is the concentration risk a concern for you?
It is. And frankly, that's one of our biggest risks that we see right now. And, you've gone from the historic concentration. So the S&P 500 top 10 stocks weighting was over 30% just a couple of weeks ago. And that was the highest in history. We've had the greatest concentration in the stock market in history. And then lo and behold, over the last week, other than the last 2 days, you saw the biggest rotation into small caps in history. And you got to be careful what you wish for here, because a rotation sounds good. We all like better breadth. We all like broader participation in stocks. But because the market's so concentrated, some of these stocks are up, and some of the semiconductors in particular, up over 100% this year. They could drop 30% easily, still be up massively for the year. But we're talking $1 trillion of potential market capitalization evaporated on that kind of move. And so even if it goes to small caps or other parts of the market, that big of a move in some of these mega cap tech names could really hurt the overall index. You got to be thoughtful about that in the back half. We want to manage that risk the best we can, moving into mid caps, looking a little bit more on value side of the house, and also looking at bonds. It's all been one trade. It's tech against the world and all asset classes. And if tech starts to stutter, we do think those other parts of the market can pick up some slack. But you got to be careful, because tech and the S&P have been so huge in the overall global market capitalization of equities.
Matt Miskin of John Hancock Investment Management, we thank you so very much for your time this Friday. Have a great weekend to you. Now, switching gears, Donald Trump taking the stage at the Republican National Convention, formally accepting his nomination for president. It was also his first public address since surviving a failed assassination attempt. Take a listen.
If I had not moved my head at that very last instant, the assassin's bullet would have perfectly hit its mark, and I would not be here tonight. 4 months from now, we will have an incredible victory, and we will begin the 4 greatest years in the history of our country. I will end the electric vehicle mandate on day 1, thereby saving the U.S. auto industry from complete obliteration. That means 2 things on day 1, right? Drill, baby, drill, and close our borders. So I better finish strong, otherwise we'll blow it, and we can't let that happen.
For more on the Republican National Convention, we are joined by Annmarie Hordern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. And Annmarie, I feel like he could not have been clearer. Drill, baby, drill, ending electric vehicle support here. How do you think that his message is getting across?
Well, when he got into the rhetoric of his speech, which is very similar to what we've seen from his rallies, he's really trying to tap into 2 issues that are pulling top of American minds, especially likely Republican voters, and that's the economy. He wants to talk about inflation. He talks about drill, baby, drill. He was talking about energy prices. We should note, under the Biden administration, we have seen record U.S. crude and record natural gas production. So they are drill, baby, drilling already. I mean, when you look at compared to the rest of the world, the United States is producing at a level we have not seen from any country. And then, of course, he used some more dark rhetoric when he was talking about immigration. He wanted to talk about deportations. He was saying it's an invasion of aliens. I would say his speech at 93 minutes long was a record for modern political history and conventions. He beat his record in 2016. In the beginning, the 30 minutes, he was trying to talk about unity. He came out talking about the fact that he dodged a bullet. If his head was in another direction, potentially he would not be there at that convention giving that speech. He tapped into God, and he talked about wanting to be a president for all Americans. But then as the speech progressed, he started to trail off his prepared remarks. And this is where you saw some lies come from the former president, also rhetoric talking about Hannibal Lecter, which he's talked about a lot in the rally. And then at the end, he was trying to give this impassioned moment. I would say, this will be sliced and diced across social media. So I think the message a lot of people will take away from this is probably what he talked about on Saturday, that attempted assassination on his life. In the room, though, there was moments of just pure silence when he was talking about that, and then other electric moments. When he says drill, baby, drill, members of his party get up and chant alongside with him.
Annmarie, we talked to Mark Zuckerberg. There's been a ton of support, especially financially out of Silicon Valley, not from Facebook, but Mark Zuckerberg did have this to say.
I mean, on a personal note, it's, seeing Donald Trump get up after getting shot in the face and pump his fist in the air with the American flag is one of the most badass things I've ever seen in my life. As an American, it's like hard to not get kind of emotional about that spirit and that fight. And I think that's why a lot of people like the guy.
So does that, moment, that assassination attempt, that iconic photograph, kind of negate the fact that Donald Trump is a convicted felon, that he's said Vladimir Putin can do whatever he wants, the fact that he seemed to encourage an insurrection to try and overturn an election?
Well, currently in the polls, especially the CBS poll released yesterday, it does seem at this moment that is resonating with voters. Of course, we'll have to see on November 5th. Frank Luntz said when voters go into the polling booth and they cast their vote on November 5th, they are going to remember that image. That image is now really, for the Republicans, for sure, the image of they want to project going into this election. I will say the tone of this RNC yesterday when I was on the floor was machismo. You had Hulk Hogan come out, call Trump his hero, and rip open his shirt. You had Kid Rock come out. It was nostalgia of the 80s and the 90s. And they want to top in potentially that propensity of, I would think, independent men to go out and vote for the former president. And when he was talking about this attempted assassination on his life, the imagery behind him, all of the images from Saturday were projected onto the screen. And they want voters to take that away with them.
All right, Annmarie Hordern in Milwaukee, thank you so much for your reporting this week. And you can watch that exclusive interview with Meta CEO Mark Zuckerberg on The Circuit with Emily Chang on July 23rd at 6:30 p.m. Eastern on BTV, or stream it at 8:30 p.m. on Bloomberg Originals. Now, going back to those global outages that we're seeing, we do have some breaking news, and that is that FedEx apparently experienced substantial disruptions. Potential delays are possible for package deliveries. We also heard from Mercedes saying that global production was partially affected by the IT issues. For CrowdStrike's part, the CEO saying that they're looking to automate fixes. Of course, we're going to be following this issue closely. Don't go anywhere. This is Bloomberg.
In terms of that member growth and churn, I'd say that the kind of outsized paid net adds in the quarter was primarily driven by stronger acquisition, a little stronger than we expected, but also very healthy, continued healthy retention in the quarter, and that's across all regions.
Of course, that was Netflix CFO Spencer Newman speaking on the company's conference call after reporting results which showed that the streaming giant added over 8 million customers in the second quarter, but its third quarter estimates missed Wall Street expectations. For more on Netflix, I'm pleased to say we're joined by Tim Nollen. He is Macquarie Senior Media Tech Research Analyst, an outperform rating on the stock. So you take a look at what Netflix shares did. Originally lower in the post market, now actually moving a little bit higher before the opening bell. Wrap it all together for us. What was your takeaway?
Sure. It was a very strong quarter. 8 million subscriber adds was nearly double what the street was expecting. Revenue and operating income beat expectations. But Q3 guidance was slightly on the light side, I think. It wasn't bad, but it was a bit of a slowdown in terms of the growth rate. Still a strong operating margin. So I think the initial stock reaction after hours was to say, well, Q2 was good, but Q3 maybe not so good. To me, the stock, pointing up a point to whatever it is right now is about right, because Q3, okay, you're going to get little fluctuations here and there anytime. But the real story for Netflix is the longer-term advertising upside. And while there's quite a bit of work to do there, I think they are doing the right things. And it's not difficult to look forward to 2025, 26, and see a very interesting growth story for Netflix.
How do you feel about the advertising story moving forward? I mean, it was convincing this quarter, but how do you model out that growth rate?
Well, I think Actually, one of the most important things that came out of yesterday's call, I think, was the announcement that Netflix will be phasing out, i.e. eliminating the basic tier. So if you're a consumer paying the lowest price ad-free for Netflix, that's going to disappear in the next whatever weeks or months. We don't know how many subscribers it is, but out of 80-some million Netflix subscribers in the U.S. and Canada, it's probably 20 million or so. That's 20 million or more subscribers that will be forced with the choice to pick another tier or drop Netflix. Some will drop Netflix, but I would bet the majority of them would go for the advertising tier. So this is really, really important because Netflix's issue with advertising is they've not had enough of a user base to attract the advertising dollars. Advertising follows eyeballs. Netflix has a huge audience, but they're not on the advertising tier yet. That's the primary focus.
I want to quickly get your take on the possibility of a Warner Brothers split. Netflix dominates the streaming space, right? Will this help them maybe take a stronger game to Netflix? Can anybody really approach what Netflix is doing?
I don't know if anyone can or needs to approach what Netflix is doing. I think everybody has to be in streaming. Yeah. So Warner Brothers Discovery, like everybody else, is doing what they can belatedly, but they are doing it. And I don't know how much the split necessarily would affect them, but everybody is chasing Netflix here.
All right. Tim, great having you on the program. Thanks so much for joining us. Tim Nollen there of Macquarie. We want to bring you some headlines right now on President Biden. His family has started discussing his exit plan from the race. This is according to NBC. Of course, the pressure has been building on President Biden to pass the torch, as so many on Capitol Hill have put it, and allow someone younger to step into his place, concerned that he is too old to go another 4 years in what John Gray yesterday said is such a physically demanding job. We'll continue to bring you these headlines as they cross. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures now have turned lower across the board. S&P futures right now down about 0.2%. We had seen green across the screen earlier. We got headlines that President Biden and his family are preparing to exit this race, and as a result, we have seen the market really turn around. Of course, those headlines were attributed to NBC. We had headlines earlier from his campaign saying that he's going to continue campaigning next week and that he's in this race to stay. We'll see how that goes. Katie, what do you see in terms of the stocks?
All right, you take a look at the major averages. Of course, as the bell rings, the S&P 500, like you said, turned a little bit lower. Right now, it's unchanged. Of course, treading water a little bit. The NASDAQ 100 off by about 0.1%. It has been an extremely volatile week, and we'll see how Friday shapes up. I want to take a look at the small cap index, though, because that rotation we've been talking about all week, of course, currently down about 2% when it comes to the Russell 2000. Now, one stock to watch here is American Express, out with their latest results this morning and boosting their earnings per share forecast for the full year. That's not enough to make up for the revenue miss, though, and you can see shares currently off by about 3%, Sonali.
Also watching Netflix, really on the rebound here, about 4%. After missing the revenue forecast for the third quarter, analysts are still largely positive on subscriber growth. Remember, Netflix widening its lead over rivals with more than 8 million added in the most recent quarter.
And CrowdStrike is still lower after the company's CEO said a fix to the global outage has been deployed. Let's take a closer look at the stocks affected with Bloomberg's Abigail Doolittle. Abby?
Yeah, Matt, we do have CrowdStrike down sharply right now, down 14.6%. It's worst day since November of 2022. And of course, this global IT outage having to do and related with Microsoft, Windows, and their operating system. So this stock down 1.7%. But CrowdStrike, they were doing an update and somehow brought about this outage. Both of these stocks down sharply. In terms of companies affected, it's almost who is not. But let's take a look at those that are most affected or talking about it the most. Travel and airlines. We've heard that 16,000 flights were affected in some way or other. United Airlines coming out, American Airlines down as well. McDonald's, they've had to close or suspend 30% of their stores in Japan due to this outage. And then JP Morgan, some workers at JP Morgan employees were unable to log on, although that stock up. One thing I want to point out here, Katie, let's take take a look at the VIX, because the VIX yesterday elevating to a 16 handle on uncertainty around President Biden. But take a look at this major spike down overnight. Whether or not it has to do with the global IT outage, we don't know. It is, of course, a SIBO product, not the LSC, which was affected. It could just have been a bad print, according to some of my sources, but elevated at a 16.5 handle or so. Uncertainty certainly entering into the markets this week, in this global IT outage not helping.
All right, Abigail Doolittle, thank you so much. And joining us now is Abby Joseph Cohen, a Columbia Business School professor and retired Goldman Sachs partner, joining us on set on this Friday. Thank you for being here with us.
Good morning.
We got to talk about the outage. So, of course, we see that affecting Microsoft. You think back to earlier this week, the geopolitical risk really slamming NVIDIA, and then you think about concentration in this market, where it feels like these idiosyncratic risks are becoming index level risks. And I'm just wondering how fragile that makes markets at this juncture.
I think that is the question of the day. Actually, it's such a newsy day. There are many questions today. But one of my big concerns since early this year has been the concentration in the market. And basically what we have had is, I don't want to call it a mispricing, but we've had such gaps in relative valuation that it's something that is probably not stable. The question has been, what was the catalyst going to be to have a swing from one disequilibrium back down to more of a valuation equilibrium? And I think we're starting to see it, whether it's the outage today, which hopefully will be short-lived, or more likely it's people recognizing that these stocks and these companies that have been identified as the best 5 or the best 7 are not the only opportunities. There are other securities that are trading at PE ratios, price to sale ratios, and so on, that are much more attractive than these are. And then there's the final question we have to ask, and that is, was everyone a little bit too enthusiastic about AI? Obviously, so many companies did invest in terms of their CapEx. Are they getting out of that investment what they had hoped? And maybe the expectations have been premature. They may get there in terms of the ultimate productivity gains from the companies, but maybe we're not there.
Or maybe not, right? I mean, I think we've all bought Jensen Huang's story hook, line, and sinker that this technology is as much of a game changer as the internet was, or the steam engine, right? And Jim Covello over at Goldman Sachs raised a really interesting point. He said most technology transitions in history, particularly the ones that have been transformational, have seen us replace very expensive solutions with very cheap solutions. And this is not a cheap solution, right? I mean, a chipset from Jensen costs like $50,000. So what do you think about that idea from Covello, pushing back a little bit? He's one of the few names I've heard do that.
Of course, I've known Jim since he first came to Goldman Sachs, and so I have very high regard for the kind of work that he does. And he can also call on the work of the other research analysts at Goldman and from the companies themselves, who are basically reporting that they're not quite seeing the returns that they might have liked or expected. So yes, that is a point. There's also the economic history aspect of it, which always intrigues me. And what people often forget is it takes a long time for technologies to become fully incorporated before you really understand what the aggregate impact is going to be on the economy. And I think that people underestimated how long it was going to take for AI to really take full form. So we don't yet know what the full consequences will be, but the early reading is disappointing in a number of industries.
Abby, if you really believe that there are other places in this market to find gains in the longer term, and if you believe in the rotation that we've seen this week, the move into small and mid-cap stocks, the move into value, how strong is that movement? How much room does it have to run?
I do believe in the rotation. My work is always based upon fundamentals and valuation. And I look for where are the better opportunities, and investors are moving into those areas where there are better opportunities. Let's keep in mind not just the concentration in the United States among that small number of beloved stocks. The United States market itself has dramatically outperformed all others. The PE ratios, price to sale ratios, and so on in the U.S. equity market much higher than they are in others. And so maybe it's also time for U.S. investors to think again about diversification, not just within the domestic market, but globally as well.
Well, thinking about diversification, especially when it comes to geography, I mean, thinking about the U.S. market, it feels like tech is too big to ignore. And then you think about the global market, it feels like the U.S. is too big to ignore. And there's a lot of great arguments for having a more global lens, but I feel like the question always is, what's the catalyst? What would cause that sort of catch-up trade?
I am a long-term bull on the United States. I'm very enthusiastic about our growth prospects. Our economy has done extraordinarily well the last few years. The labor markets are great. Corporate profitability is great. ROEs are unprecedented. So don't get me wrong about my thoughts here. But I do think that there are some other markets that are not priced for perfection, and that's where the opportunities are. And I always look not just at the valuations based on fundamentals, but rather if you are either overvalued or undervalued, which is the usual case, you're not typically at fair value, what will the catalyst be to get that pendulum swinging again? We have seen the pendulum start to swing in technology in the United States, but I'm always thinking intermediate to longer term, and one of my concerns is this. If we have a change in policy in the United States which is not supporting long-term investment, for example, we've had legislation of 3 important types passed in the United States over the last 2 or 3 years. One is to support public infrastructure, including spreading out the use of broadband and internet in rural communities throughout the United States where it was in very poor shape. Not to mention rebuilding bridges and roads and airports. The second thing that we are investing in now is our own technology through the CHIPS Act, making sure we're building semiconductor fabs in the United States. And the third thing that the legislation has enabled is investment in energy and alternative sources of energy. And one of the things we know, whether it's the AI revolution or the use of cloud computing and so on, is we need a lot of electricity. We have to make sure our grid is up to standards. We also have to make sure that we're taking advantage not just of hydrocarbons, but also of alternative sources of energy. And one of my concerns as a potential catalyst would be, what if the Congress does not continue to fund what I consider to be significant intermediate and long-term priorities?
Well, Abby, on that topic, we do have to get to some breaking political news. Stick with us. We are just getting started, but let's go now to D.C. and talk to Annmarie Hordern. We've gotten a few headlines, of course, in the last couple minutes, of course, from NBC reporting that Biden's family starts discussing his exit plan from the race. We just heard from the White House, Annmarie, that the NBC report on the Biden family is wrong. So even still, the pressure has become much louder in the last 24 hours. What do we know right now about the president's thinking?
Well, what we do know is that this has been a cycle. Democrats will come out. There'll be more reports in the press or publicly, some Democrats asking for the president to step aside, or reports that he's thinking about it. And the White House and the campaign say that is categorically false. He is in this to win this. And that's what we just heard from the White House following this NBC report. Let's bring a little bit of what that NBC report is talking about. They say the overall tone of the conversations has been that any exit plan, should Biden decide to take that step, as some of his closest allies increasingly believe he will, should put the party in the best position to beat former President Donald Trump, while also being worthy of the more than 5 decades he has served the country in elected office, these people say, and they are citing 2 people familiar with the discussions. It is why this weekend is so critical for President Joe Biden. This is one of the most important weekends of his storied decades in politics. The pressure is mounting on him from some of the most prominent voices within the Democratic Party. Chuck Schumer, Nancy Pelosi, his former boss, former President Obama. In the Washington Post, a report that he is losing faith and potentially that Biden is going to be able to beat Donald Trump. The New York Times yesterday saying that Biden has begun to accept the idea that he may not be able to win in November and may have to drop out of this race. And then our own reporting at Bloomberg is that his own cabinet is discussing whether close aides should convince him to step aside. So you can see the pressure mounting, even though the White House is saying they deny this. Of course, the big question becomes, if he does step aside, what does this look like? Does Kamala Harris, his vice president, take the top of the ticket, or potentially do we go into August with maybe a mini primary before this Democratic convention?
Right. I mean, you know, Abby Joseph Cohen just laid out 3 of the accomplishments of the Biden legacy. And I don't think anybody in the Democratic Party would debate the fact that he's achieved really some gigantic legislation for this country. Now they want to keep that in place. Now they want to make sure that that isn't all wiped away by a red sweep. How are they going to do it with so little time left until the election?
Well, that's the question. The timeline is so short right now. You have the DNC in the middle of August, and there's debate within the Democratic Party if they should bring up the virtual roll call to basically cement Biden's delegates going into that DNC. Does someone contest him at the election, a la 1968? This is why there's so much discussion in the Democratic Party, and it's in stark contrast to where I'm sitting now in Milwaukee with the RNC, where there's a lot of deep divisions within the Republican Party, but they were trying to show one of unity yesterday, especially when they appointed their nominee official being Donald Trump. And that is why you have, if the Democratic Party continues to believe, as they say they do, that Donald Trump is a threat to democratic institutions, they want to make sure they win, and they don't believe Biden is the right man for the job at the top of the ticket. That's why you see all of these leaks. If Biden is able to stand through this weekend, he's able to continue to campaign through this weekend, or currently he's in isolation because of COVID, but if he's able to hang on to his political career through this weekend, next week what I would look out for is who these individuals, these names that are leaking to the press, who comes out publicly and asks him to step aside.
Annmarie, we thank you so much for your reporting in Milwaukee. Of course, a busy day, busy weekend ahead for you as well. Coming up, much more with Abby Joseph Cohen of Columbia Business School on these very complicated markets that we're looking at. Stick with us. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's take a quick look at where stocks are trading right now. The S&P 500 unchanged, but you do see red arrows there on the NASDAQ, down just by a bit. The Russell 2000 by a bit more. A global IT outage has disrupted business and services, from airlines to banks to the 911 emergency alert services. So that's something that we're still watching, and the effects on Microsoft, which is really at the center of these outages, and CrowdStrike, which in some ways has been blamed. Those outages have been fixed now, but it's going to take a while for the ripples to settle down. We have Abby Joseph Cohen with us, a Columbia Business School professor, retired Goldman Sachs partner, of course. And Abby, you know, we talk about the intersection between politics and the economy. Jason Furman, who used to run the Economic Council for President Obama, had a really interesting tweet yesterday outlining some announced economic policies that he thinks would be consequentially bad. And he orders them starting with 10% across the board tariffs, then $4.5 trillion of tax cuts, threatening the independence of the Fed, which you just brought up. It seems to me that that could be the worst of all, threatening the independence of the Fed. But I guess the reason that Jason only listed in spot number 3 is that it would be difficult to do.
There are a number of concerns that I would have about a change in policy. We talked, for example, earlier in the show about what happens if some of these long-term priorities are not properly funded, and that would be a lost opportunity for the U.S. economy to stay competitive and to continue to grow in a thoughtful way. In terms of the Fed independence, I am concerned because one candidate, and I'm not here to talk about politics, just policy, but one candidate has made it clear that he would like to interfere with FOMC policy. And in the past, when presidents have done that, it hasn't gone well. It tends to be highly inflationary because presidents like stimulation and stimulus to come from Fed policy. They don't necessarily want a measured, balanced approach. So I worry about that. I'm also very concerned about the discussions about tariffs, across the board tariffs. You know, there are some instances where a tariff makes sense. For example, if another country is dumping stuff in the United States, or in cases, and we've seen this in China, unfortunately, where they are manufacturing so much more than total global demand. That is something where a tariff may in fact be appropriate. But to have across-the-board tariffs are damaging to our economy because it's inflationary. It's damaging to other economies because it could hurt economic growth. We'd see particular impact on our friends in Asia, not just China, but our friends in Asia, and also our friends in Europe. And that to me is very concerning because it's something that could ultimately trigger a recessionary type of condition. We saw that in the 1930s, for example. I also worry about fiscal policy in general, but something that I have a somewhat contrary view on has to do with the focus on deregulation. There is a presumption on the part of many investors that deregulation is good for the economy, therefore good for the markets, and I disagree. I think good regulation is actually very helpful in terms of stimulating long-term economic growth. A free-for-all in industries is not a good idea. And I also worry about the Chevron deference, the Supreme Court decision that basically reversed that long-standing policy. What would happen under one of the candidates, because he's been talking about it, is to get rid of a whole level of experts in a variety of agencies, basically the scientific and engineering and technical experts, and replace them with political appointees. I don't see how complicated, complex industries, including technology, finance, energy, I don't see how they can perform as well as they have been performing if you take out that level of expertise.
Abby, I wish we can go longer. Those are some big thoughts about what 2025 could look like. We do have to leave it there. We are up against the clock. That is Abby Joseph Cohen of Columbia Business School. We thank you so much for your time. And coming up, we're going to talk about the bankers worldwide that have been caught up in this global IT outage. We're going to discuss that in our Wall Street Beat up next. This is Bloomberg.
This is Bloomberg Open Interest. A quick check on the stock market right now. 24 minutes after the bells rang, you can see the S&P 500 pretty much flat on the day. The Nasdaq 100, big tech starting to rebound a bit, of course, as it feels like industries across the globe grapple with outages. The Nasdaq 100 up about 0.1%. Small caps, we hardly knew you. The Russell 2000 down almost 2% right now. A pretty brutal end to what has been a great week for the small caps, Sonali.
We were winning for a while there, Katie. You know, what goes up must come down, I guess. Well, we're going to go on to our top story today. For today's Wall Street Beat, bankers caught up in the global disruption, some unable to log on or make trades. Of course, guys, we're looking at firms from JP Morgan in Hong Kong to Balyasny in Singapore. Big companies. I will say a person familiar with the matter has said for JP Morgan, at least all branches will be online this today and throughout the weekend. But nonetheless, very disruptive.
Well, but the interesting thing is, or the important thing is, that everybody worked quickly to get things back. And of course, banks have fail-safes, right? They don't just use one server system. They have others that they can go to. So while you could see an outage for an hour or two, they're very likely to get back on track.
Yeah, it's going to be interesting to see in like 3 months' time what the comments in the earnings calls could be, because as we heard, I mean, this will have some impact. A day matters.
Airlines, FedEx, bigger deal for companies outside the banks. But for the banks, the fact that the London Stock Exchange's news service being down, big deal if you were trying to get news out this morning.
Yeah, absolutely. Let's get a look at what you should be watching for the rest of, for next week. New York Fed President Williams in the next hour, and Atlanta Fed President this afternoon. So that's today. U.S. executives will head to China next week to meet with officials following the country's third plenum. On Tuesday, we get big tech earnings from Tesla and Google. On Wednesday, Benjamin Netanyahu addresses the U.S. Congress. And on Thursday, we'll get U.S. GDP. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, a major software crash disrupts travel, trading, and banking across the globe. And what could be the largest IT outage ever?
These disruptions adding to tech's troubles at the end of a week that's seen the NASDAQ shed more than 3%.
Plus, Trump outlines his America First policies while pressure mounts on Biden to bow out. Let's take a look at these markets on this Friday morning. The S&P 500 right now clawing back, currently unchanged. The NASDAQ 100, same thing too, treading water there. We were lower, then we were higher. Now we're just about even. And then the 10-year yield, the Treasury market selling off a little bit, at least on the long end. You can see 10-year Treasury yields currently up about 4 basis points, Sonali.
And back to that outage, computer systems at airlines, banks, and businesses around the globe have been disrupted after a botched update of cybersecurity program that CrowdStrike took down. Microsoft systems as well had issues. CrowdStrike CEO George Kurtz says a fix has been deployed. Separately, Microsoft also reported an apparently unrelated problem with its Azure cloud service. For more, we're joined by Ed Ludlow, co-host of Bloomberg Technology in San Francisco, and explain. I think it was necessary to explain exactly here what happened, particularly because we had two companies with unrelated seemingly issues.
Yeah, I mean, the timing is somewhat curious, but the basics of it are that this only impacted Windows hosts. So in other words, if you were a corporate or consumer user of Mac OS or Linux out there around the world, you weren't impacted. And specifically, what happened was CrowdStrike is pretty much the single biggest player, individual player in a market for what's called modern day endpoint protection. Think of it as like constant monitoring for ransomware threats. Old school archaic antivirus software would basically wait for your computer to show symptoms that you had some kind of malware or virus, and then it would respond. Endpoint protection constantly monitors, looks at data and signs, but in order to do that, it has to be granted direct access to your system. And so that's what happened. They did a faulty or corrupted patch of their software intended to improve ransomware protection. And the result was many, many Windows users around the world getting the dreaded blue screen. And as you guys have been talking about brilliantly, it's everything from the woman at the check-in desk on United. There's a really viral photo out there doing the rounds about somebody trying to help her hard reset the computer, to the banks, to infrastructure. It's astonishing, but it's not a hack. It's a cyber or IT outage.
Yeah, and of course that is important to remember here. But I am curious, I mean, what's the path forward here? We were talking about this with Mandeep Singh a little bit earlier. Even though this wasn't a cyber attack, it seems like this will be relatively short-lived. Do you think about the reputational impact for CrowdStrike? Could this allow some of its peers potentially to take some share?
Well, so CrowdStrike controls about a fifth of the market for endpoint. And the number two player, ironically, is Microsoft, who have their own problems with an apparently separate Azure outage. But the CrowdStrike product is also expensive. So if you think about the corporate context where a company has tens of thousands of employees and therefore computer users, not each one of them will necessarily be licensed for the product. It's about $50 per head. That means that only certain but likely mission-critical computers were impacted. So the options are basically that the IT guy comes out of the office, runs down the hallway, and helps you with a hard reset. But if you're a company of 10,000 and you've only got 5 IT guys, it's obviously going to take a while to do that if you're still waiting for the update or fix that's been issued by CrowdStrike to take effect. I mean, I don't mean to make light of it, but this is what we're talking about. You need to just kind of hard reset or reboot your Windows computer.
Ed Ludlow, as you know well, just turn it off and turn it back on again. Bloomberg Technology co-host Ed Ludlow talking to us about the great IT outage of 2024. Joining us now to talk about the markets, Kara Murphy, Kestra Investment Management Chief Investment Officer. And first of all, great to have you on the program. Thanks so much for joining us in studio. I think this really highlights a separate but parallel market issue, right? We have one outage with Microsoft Windows devices, and it stops airline travel globally. It makes it difficult in multiple states to call 911, and you can't put trades through. If we look back a week to, when the Biden administration floated the foreign direct product rule against some, chip makers, we saw just the stocks falling, and that pulled down the entire index, right? Do we have too much concentration in this market.
I actually love that parallel because I think it is very apt. You know, we've had 18 months of the market being driven by a handful of names who are heavily levered to the semi sector, right? And earlier this week, we saw what happens when all of a sudden they stumble. And it wasn't a huge stumble, right? They still have great businesses, they have great earnings power, but I think the market has become overly reliant on just a handful of names. And in order for this market to remain healthy, for the bull market to continue, we have to see that start to broaden out. And we have seen that, obviously today notwithstanding. But I think this is very healthy for the market to not be totally reliant on a couple of names.
But then you think about the next couple of weeks. Of course, we're getting into the heart of tech earnings season in the next couple of weeks. And then, of course, we're going to see some of those smaller names report and have a chance to actually back up some of the stock performance that we saw this week. Do you think that they'll actually deliver the fundamentals needed to sustainably support that broadening out?
I think that'll be the $64,000 question. And so up to now, the tech names that have led this market have done so with tremendous earnings power. So this has not been on fumes. This is not like 2000 when you have names that are trading on eyeballs. Small caps, on the other hand, when we look at the earnings trajectory, has been much slower. That recovery has been much delayed. But I also think the market is going to give small caps a little bit more time for that earnings power to come through, simply because the valuation differential between smaller names and larger names is at historic wides. You don't have to be that much more optimistic to believe that these are good buys from here.
Well, then how do you pursue the rotation? Is part of this meaning taking profits off of those big tech names and adding them to value, adding them to small and mid caps?
I think on the margin, yes. So it's very hard to be able to time when the market starts to rotate. Certainly with this, the prospect of Fed rate cuts coming sooner, the market's starting to move on that. But what we see is even core indexes are so heavily reliant on large cap and growth that any opportunity to kind of diversify outside of that will help give you a little bit more balance in a portfolio. And mid caps in particular, I think, is a great way to kind of play that, where you have really strong businesses, good earnings growth, but you're not going so far downfield into small caps.
Do you need the Fed to get on a sustained cutting path for the earnings recovery, for the S&P 493 earnings recovery to be sustainable itself?
It doesn't hurt. Those names are much more heavily reliant on funding, right? They've been much more pressured with higher interest rates in general. And so certainly with those rates coming down, that's going to be a big tailwind.
They're coming down for now, right? Because the question around the election is, if Donald Trump puts tariffs on everything, if he cuts taxes drastically, if he, not only stops immigration at the border, but also deports 15 million workers, that could be really inflationary, and the Fed would then have to raise rates.
That might be then a different type of macroeconomic environment, but those things also take a while to play out. And we've been of the view in general that inflation is probably not going to be sustainably at 2% anyway, and that's okay. So the question is how much of an impact that has, and then how long it takes to actually take root.
I want to go back to the concept of the rotation. Like Sonali was saying, do you book profits on some of your big tech, put it into the small caps? Why wouldn't you just take it from cash? You think about $6 trillion.
If you have cash.
But $6 trillion is sitting in money market funds. And I think it's been interesting, the conversation around the rotation. It doesn't seem like it's a zero-sum game here.
I think that's a fair point. And we see a lot of people who are sort of sitting in those cash accounts because it's very comfortable. Like, why do I want to get out of that if I have 5% guaranteed? And there are a couple of reasons why. We think you have better opportunities longer term in riskier assets like equities. And I also think some of those numbers that look at, like, say, money market balances are a little skewed because for so long in a low interest rate environment, it didn't make sense to go into a money market. So not all of that is actually deployable into equity and bond markets.
Look at I just pulled up the MMFA index, the money market funds index.
Yeah, it's crazy.
It is shocking. I mean, to see that much money, and it's appreciated so quickly. We were looking at, less than $3.5 trillion in 2019, and then all of a sudden we go through this, great helicopter money handout of the pandemic, and we're looking at massive amounts.
How important, Kara, is the safety trade? If you keep money in cash or buy gold or even, look to other places here to hedge this market, how are you thinking about that?
So it's been interesting, too, to watch Treasury markets because Treasury markets are still acting as a safe haven. I know they haven't felt like it over the last two years because we've had dismal performance. But what we're seeing is that as people start to get a little nervous, they still are looking to the Treasury market for that bit of safety. Gold, I think, has become another really interesting trade. We don't love it as a strategic asset class, but clearly people are using that as a way of hedging these different types of risks.
All right, Kara, it's great to speak with you. Really appreciate you taking time on a Friday. That, of course, is Kara Murphy of Kestra Investment Management. Let's get a look at what's moving underneath the hood right now. We're going to do that with Abigail Doolittle.
Well, of course, Katie, we have to take a look at these stocks that are affected or were a source of the global IT outage. So first, CrowdStrike, and it was their upgrade or changing around the technology on the Microsoft operating system Windows that created this outage. And you can see both of these shares down. Well, not so much. Microsoft is coming back from an almost 2% decline, but CrowdStrike is down 9%, well off of its lows. At one point overnight, it was down, or in early trading, it was down 21%. On the week, it is still down sharply, the worst week since November of 2022. As for some of the companies affected, McDonald's, those shares down 1.3%. They've suspended operations in 30% of their stores in Japan. The London Stock Exchange right now in London trading down about 0.75%. Their news feed was disrupted. And then, of course, airlines, that's where we're really hearing about the pain. 16,000 flights may have been affected. Both of these shares, American and Delta, are down. Let's take a look at the airlines most affected. This was a little bit surprising because United seemed to be the airline addressing it most quickly, but it actually, Delta, the flight cancellations the most, 477, followed by American, United, Endeavor, and then KLM there. Lots happening on this Friday, and this global IT outage, certainly a big piece of the story.
Absolutely. Abigail Doolittle, thank you so much. Now, coming up, President Biden is facing unprecedented pressure to drop out of the 2024 race. We get the latest next. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. The Fed has been laying the groundwork for a rate cut in September amid growing confidence that price stability is within sight. However, San Francisco Fed President Mary Daly says some recent inflation data has been good, but we're not there yet. That's a direct quote. She flagged the need for policymakers to focus on both of their mandates. Former President Donald Trump used his nomination speech to take aim at President Biden's electric vehicle policies. Trump pledged to end policies that favor EVs on his first day in office. He also promised lower taxes and energy costs and an end to the illegal immigration crisis. Katie?
And staying on politics, NBC reported earlier that President Biden's family has started talking about a plan for him to exit the 2024 presidential race. But minutes later, a White House spokesman says that the report was wrong. For more, we're joined now by Annmarie Hordern, Bloomberg's chief political correspondent, the co-host of Bloomberg Surveillance. So a lot of mixed messages here, Annmarie. How important is this weekend?
Well, this weekend is critical for the president. He's getting even more politically isolated, and he's physically isolated in Delaware right now. And he had to stop short his campaigning this week to go self-isolate in Delaware. Why this NBC report is so interesting, because if there's anyone that's going to be able to convince the president to step aside, it's going to be members of his family. And this is what the report says. The overall tone of the conversations has been that any exit plan, should Biden decide to take that step, as some of his closest allies increasingly believe he will, should put the party in the best position to be former President Trump, while also being worthy of the more than 5 decades he has served the country in elected office, these people say. Now, we should note, the White House and the campaign firmly deny this. They say Biden is sticking in this race. Biden has come out and said the delegates are his. There have been gaps in explaining what could make him potentially step aside. ABC earlier this month, he sat down with George Stephanopoulos and he said the Lord Almighty would have to come down and convince him. At a NATO press conference I was at with the president, he said potentially if had hard data, if polls showed he could not beat Trump, he'd be convinced. And then most recently this week when he sat down with BET, he said if there was a medical condition that has emerged. So you do see some cracks in the president's reasoning. At the same time, the pressure mounting. This NBC report is citing a conversation within his own family, but this entire week it's been a drip of reports from the likes of Senator Schumer, Hakeem Jeffries, Nancy Pelosi, and former President Barack Obama saying they are concerned that he's going to lose this race.
Annmarie, I guess at the end of the day, why does it come down so much to his own family and his own decisions when you're hearing a growing chorus of Democratic senators and former very prominent officials really step up to the plate with their concerns here?
I think part of it is that Democrats have counted Joe Biden out in the past. Look at what happened in 2016. They really looked him over. He said he got out of the race because of the death of his son, but they went for Hillary Clinton. He's been counted out before in the past, in his personal life as well as in his political life. And he's been known as the comeback kid, and that is why everyone is saying this is so critical for him to make this decision on his own. But really, he's so close to his family, and he will make this a family decision. They talked about it, a number of times throughout his administration, whether or not he would seek re-election as a family decision. They decided he will, and now it's going to come down to his family and him himself making this decision, whether or not he decides to step aside. The most important individual surrounding him within his family, though, he has a lot of grandkids. Of course, he has his son, Hunter Biden, who we're now hearing is a part of more conversations, is his wife, Dr. Jill Biden, the First Lady. She is really his North Star. And if there's anyone that's going to help him make this decision, it's going to be her.
I encourage anyone at the Bloomberg terminal, Annmarie, to check out WSL space election on the terminal. You see, for example, the betting market odds. Predicted has a 27% chance that Kamala Harris wins the presidential election versus 62 for Donald Trump and only 12 for Joe Biden. What are you hearing about the vice president in terms of her readiness to campaign?
Well, she has been on the campaign trail as well. One message she's been really focused on is a vulnerability in the Republicans. Donald Trump's speech last night, he hammered home two issues that are top of the pile for Republican voters: immigration and the economy, especially when he talks about inflation. One thing he did not mention, which part of his base want to see them talk about, is the fact that his Supreme Court, or justices that he was able to get on the Supreme Court, knocked down Roe v. Wade. And Kamala Harris has been out there campaigning on this, trying to get into the minds of independent voters why they should leave their couch November 5th and go vote for the Democratic ticket. So I imagine she is going to really want to lean in this message, because it's a vulnerability for the Republican Party, for those centrist individuals when it comes to abortion. Many think they're too extreme. When you look at some of the polling, when it comes to the economy and immigration, they say Trump would be a better president. When it comes to things like reproductive rights, they look to Joe Biden.
Well, Annmarie, you know better than most that the timing is very, very tight here. Of course, the DNC approaching in mid-August. Just walk us through what a potential timeline would actually look like here again.
It's honestly anyone's guess. It's a very gray area. It's uncharted territory. But what potentially I would say is the last final moment would likely have to be the day before the convention, unless they want absolute chaos on their screens, the Democratic Party, I mean, from networks being wall to wall on how this is contested, and they are very divided, deeply divided. That will be the takeaway if they don't have this shored up going into the Democratic National Convention kicking off in a month's time. So I would say that is really the do or die deadline. Of course, there's a little bit of this gray area as well with the fact that they want to bring up the roll call vote virtually. Depending if that goes through, we can see maybe where the balance is shifting within the Democratic Party. If they bring that up to August and Biden is able to hold on to that, it's going to be very challenging for someone to contest him at the convention. But if they push that back, potentially giving him more leeway to step aside closer to the convention.
Annmarie, thanks very much. Annmarie Hordern there out of Milwaukee, where she spent the week at the Republican National Convention. Still ahead, we're going to take a look at the companies making the most social buzz today. Social Climbers is next. This is Bloomberg.
Time now for Social Climbers, the company's making social waves this morning. And first up, it's dark times for SunPower, the solar company telling clients that it's pausing some operations and halting new product shipments. Guggenheim cut the firm's price target to 0, saying the stock is basically worthless and may soon be delisted. Next up, we have Hawaiian Electric among the companies that have tentatively agreed to pay over $4 billion to resolve hundreds of lawsuits over the wildfires that ripped through Maui last year. Now, if approved, the accord would settle suits on behalf of thousands of homeowners and businesses against the utility company. And finally, Apple is in talks to license more films from major Hollywood studios as it looks to boost its Apple TV Plus streaming service. Now, the tech giant licensed about 50 movies from Hollywood earlier this year, including classics such as Mean Girls and Titanic. But still a long ways to go. Just 11% of U.S. households subscribe to Apple TV Plus, compared to about 55% of households that use Netflix. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. And guys, I have to say, I'm a big Netflix user, but I did get Apple TV just to watch the morning show.
Favorite for me too. Watched it twice actually.
Really?
I did.
Yeah,
But that's
it was too soap opera-ish for me. I need to have like spies involved, or else I can't.
You need real life news with me and Katie in the morning is what you need.
Yeah, actually, you're enough of a morning show for me. So I think it's fascinating that only 11% of households subscribe to Apple TV. I would have thought they're much more successful, because I imagine far more people than that use the Apple TV box in order to navigate.
And here's the thing, let's get serious about it too. You have Netflix, for example, coming out, really widening its lead over rivals, 8 million subscribers, beating on every single market around the world. But also on top of that, really touting the other things they do. Games, for example.
I never knew.
Who knew?
Apparently they have 100 games.
Yeah, I didn't know that either. I will say, I mean, you think about the streaming wars, it feels like we're talking about just a cohort of other companies. It's like Netflix, and then there's the streaming wars with everyone else. Again, just speaking to that dominance.
A lot of them are now introducing commercials, right? Hulu has interjected these commercials, and I guess there's a lower tier for Netflix as well. I can't sit through them.
I think you had a great comment that you made with a guest a little earlier about this idea that Warner Brothers, if they spin off that streaming service, can they actually compete? The funny thing is, we had Golden Tree's Stephen Tannenbaum yesterday saying that he would invest in Warner Brother bonds if they saw this happening. So maybe it's a benefit for somebody.
Yeah, maybe for the bond investors, the equity holders. I don't know. It'd be interesting to see how they feel. Now, coming up, Sallie Krawcheck says the tectonic plates of wealth management are shifting and that the future is female. We'll speak to the founder of Ellevest next. This is Bloomberg. Well, Sallie Krawcheck has over 25 years of experience on Wall Street. Now she's putting that knowledge to work, helping women build their own wealth. That's the goal behind Ellevest. It's a financial literacy and investment platform that she founded. And I am thrilled to say that Sallie joins us now. Great to see you in person.
Hey, good to be here. Thanks for having me.
I was so drawn to a column that you wrote in the Financial Times in late May, talking about the coming feminization of wealth. And you talk about, again, those tectonic plates, and sort of to set up the conversation, if you could describe to us what you see in the offing, that would be very helpful.
Yeah, so we've all heard about the great wealth transfer, where the boomers have created the most wealth in history, and the gentlemen are beginning to hit 79, 80. What happens when you hit 79 or 80 is you begin to die, and the money then goes, most folks talk about, to the next generation. But in fact, because women live 6 to 8 years longer than men, because half of marriages end in divorce, a lot of that money, and we can debate, is it $40 trillion, is it $20 trillion? Some people say $80 trillion, but it is a boatload of money is going to the spouses. And so what we are seeing, beginning, is what we call the feminization of wealth, where women are on their way to having the majority of wealth in this country, and very importantly, deal with and invest their wealth differently than men do.
So what does that mean for the investing landscape? Because you hear all the time in these sorts of conversations that women tend to be more risk averse when they invest.
It's their fault. It's their fault. They're so risk averse. They're not good at math. They need more financial education. They don't like to trade. It's their fault, right? This would be sarcasm because none of that is true.
Right.
And what we find at Ellevest is it's not that women are risk averse. It's that they're not buying what the industry is selling. That when that money comes into their hands, they typically leave their joint financial advisor, the one they had with their husband, at a rate of what can be 80 to 90% over the next year.
Amazing.
Only about a third of them, our research shows, know what to do, so they tend to put it in the bank. And so it's not something inherently wrong with women. It is the fact that the industry has been very male-dominated, and it is the fact that media has given women messages about the scarcity of wealth, about how they're buying too many lattes, about how they're having too many facials. And so women tend to retreat.
That point on the industry, I think, is really interesting and important here, because for all the amount of kind of, talk that the banks have had about more women in the workplace and serving more women as clients, you still see almost every major bank still has their head of wealth management as a man. And so do you believe that the workforce is broadening at this point?
Well, and there has been some progress made, and let's be very clear about that. But particularly amongst financial advisors, it's still 80+% men. And there's a lot of energy around it, but inertia is a very powerful force. If you are making a boku of money serving mostly white, middle-aged white men, why would you change? Why would you disrupt your business to make it different in order to serve women if they happen to be looking for different things? That's why instead of starting an Ellevest within a company, we started it from scratch.
I had a great talk with a venture capitalist friend of mine over the weekend, Jessie Draper, and she mentioned that female founders still only get 2% of venture capital. And that's a number that I heard, 10 years ago. When is that going to start to change?
Well, why does it have to change? First of all, Jessie's terrific, and they are an investor in Ellevest. And it's 2% for CEOs overall. Within fintech, it's something like $1 in every $10,000 women CEOs get. They get very few of them. When is it going to change? Does it have to change? Does it have to change? Just because it feels like that's unfair, it should change. When, venture funds are making a lot of money, there's innovation, why does it have to change? Now, where we see it changing is in the early stage, the seed, the Series A. You have wealthy women who are saying, I'm going to use this wealth that I've just received, and I'm going to invest in other women. So that's where the change is starting.
I do want to talk about how Ellevest fits into this coming wealth transfer, of course. When you think about what your platform is built to be, being a part of helping women invest, how do you build a business around that to actually capture and help accelerate that?
So we help women invest from their first dollar through a digital offering, the only one that takes gender into account, which matters if you're a woman and you earn less and you take more career breaks and your salary peaks sooner and you live longer. It matters, through to financial guidance and through to private wealth. And so we have clients who have everything from a few dollars with us to multiple tens of millions, serving them with financial advisors like the other wealth management businesses there. We find women tend to be particularly interested. I know that, ESG is a bad word now, but women are like, no, I understand that every dollar I invest has an impact, and I want to know what that impact is. And whether you call it ESG, whether you call it impact investing, whatever you call it, I want to know the impact my money is having, and I want to make a positive impact.
Sallie, what is the biggest question you get from women who are looking to stop putting their money in the bank and start putting their money to work?
Where should I start? How much should I start with? We also see from a lot of women sometimes guilt about it, guilt about leaving an existing financial advisor. We say the fine financial advisor. If someone says they've been fined for years, that they lost me a few $100,000 by overtrading, but I don't want to hurt their feelings. And so because women have been socialized to take care of everyone else, we sometimes see they're reluctant to leave others. But then it's, how much do I need to know? My friend Reshma Sojani says that boys were taught to be brave and girls were taught to be perfect. And so what we see among women is, do I have to know this entire encyclopedia of investing terms before I start, or can I start by only knowing half of the investing terms? And so learning that you're not going to know it all, finding someone you trust, and beginning that journey of investing is the key.
It reminds me, of course, of imposter syndrome, and that's a whole different conversation. But before we let you go, I do want to talk a little bit about generational divides as well, because you mentioned financial advisors, of course. And I'm wondering, for younger investors, maybe investors and particularly women investors who are starting their investing journey, are financial advisors still relevant?
Financial advice is still relevant. Finfluencers are scary, because they are incredibly entertaining to watch, but those who are most entertaining, I think I saw research, are the most likely to underperform. And so they're sort of driving an active management, cutesy, funsy sort of thing, which worries me. The key is, look, get started early, a bit out of every paycheck, a diversified investment portfolio, don't try to actively trade. But time, as I don't have to tell y'all, because of the power of compounding, time is your friend. So it's never too early, but it's also never too late. For those women we see who are in their 40s, 50s, oh my gosh, I didn't get started in time. It's time to start now.
Sallie, have to leave it there. Really enjoyed this conversation. Hope to see you again soon. That, of course, is Sallie Krawcheck of Ellevest. Let's get a check on these markets. We're going to do that with Bloomberg's Abigail Doolittle.
Well, we are looking at session lows on the day for the NASDAQ 100 relative to the futures overnight. And you can see the NASDAQ 100 after a pretty rough week overnight during the Asian session had been higher. But then amid the the global IT outage, a dip lower. And now we're back down toward those levels, down about 0.5%. We're looking at a second down week in a row for the NASDAQ 100, down more than 3%. Its worst stretch since April relative to the rest of the markets on the week. Let's take a look at what is going on, because we do have the S&P 500 also heading to a down week, down 1.5%. It is a risk-off week. Take a look at the VIX, and we'll be taking a closer look at the VIX in just a moment. But above a 16 handle, the 10-year yield, on the other hand, higher. So there's not a bid for bonds. So there is a bit of an interesting contradiction there. But this could certainly be pressing on stocks as well, along with that rising yen. And then the Bloomberg Dollar Index up 0.4%, which is interesting given that action in the yen. As for the VIX, let's take a closer look, because this is really, really interesting what is happening here. And this is actually a chart of NVIDIA, the VIX, that curve steepening above a 16 handle on the uncertainty. But this chart's actually much more interesting, I would argue. So thank you to the control room for getting it in here at the last minute, because NVIDIA has started to turn lower. Right now, it is at a really critical level. It's at 119. If it goes below 118, which would basically set this topping pattern into motion, this gap down here below 100 would likely fill. Right now, just hovering above that 50-day moving average. You can see the RSI, or momentum, continuing to go down, suggesting that NVIDIA at some point, whether it's today or next week or the week after, is very much likely to go through that 118 level. If that happens, that could really, as the third biggest weighting to the S&P 500 and the NASDAQ 100, Katie, have a big move on markets, and also from a sentiment standpoint, as has been the case this week.
All right, Bloomberg's Abigail Doolittle. Thank you so much. Now, coming up, a return to office hasn't solved all of commercial real estate's problems. Boston Properties CEO Owen Thomas tells us why perception is worse than reality. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And commercial real estate's rough patch might not be over yet. Boston Properties CEO Owen Thomas told Bloomberg's David Weston what's affecting the recovery.
It has been a rough time. I always say, though, perception is worse than reality. And commercial real estate is bouncing back, defined as office. There are two external drivers that really drive the office business, certainly the business of BXP. One is interest rates, and the other is corporate earnings growth. I think the interest rate story is pretty obvious. We're real estate stocks, real estate are primarily a financial asset, and if the cost of capital is lower, those assets are worth more. We had a very favorable inflation report last week, and since that came out, and with the prospect of more rate cuts and the fact that the 10-year now is below 4.2%, it's really escalated our stock price over the last week. The second important driver is corporate earnings growth, because that drives leasing. In 2023, the S&P 500 earnings growth was flat, 0. In 2022, it was very tepid. But here in 2024, in the first quarter, it was up 8%, and this quarter is predicted to be even higher. So when companies are profitable and they're making money, and they're growing their earnings, they're more likely to grow, hire people, and take more space. And we're seeing that in our leasing activity. In the first quarter at BXP, the square footage that we leased was up 30% from the first quarter of 23. And in the second quarter, we're seeing continued escalation, both in terms of signed leases and our pipeline for future quarters.
Up 30%, but is that off of a low base?
It was off a low base, yeah, because we went through, as interest rates went up, in 2022 and 2023, as I mentioned, corporate earnings growth slowed way down. And when that happens, companies aren't growing. They're thinking about ways to cut costs. And we saw that. A lot of sublease space got put in the market. There wasn't a lot of new requirements in the market. But now that the environment around corporate earnings is improving, it's improving our leasing because companies are growing again.
So strong corporate earnings make it a little easier to hire more people, as you say.
Yes.
You have to actually get the people into the office.
Yes,
You're
that's
gonna
true
be able
too. That's true too.
How's that going? How's return to office going?
Yeah, I do think there's no question that work from home has an impact on office demand. I do think in the premium sector where we operate, it's a little bit less so because the clients that we have generally want their employees to be in the office many days per week. But in terms of what we actually see, BXP manages today about 54 million square feet, and we have badge data on about 50% of that space. And so what we're seeing today versus the last quarter before the pandemic is in New York, Tuesday to Thursday, on buildings that are comparably leased, the visitation is the same. So in other words, the badge swipes haven't diminished at all. So Tuesday to Thursday, New York is back. And Monday is coming up slowly, and Friday's very slow. I mean, by the way, Friday was slowing down before the pandemic, but it's definitely slower today. So that number in Boston is about 80%, also rising. So Boston is also improving Tuesday to Thursday. And then San Francisco lags. It's at 52%, but again, that is slowly improving. And the other thing that we see in the data is that if you look at the unique weekly visits of a worker, that gap between the East and the West Coast is less. However, those individuals are coming into the office fewer days per week on the West Coast than they are in New York or Boston.
When it comes to the stock market, it's been driven so much this year by that so-called Magnificent Seven, which seems to be a lot of it related to artificial intelligence.
Yes.
Is that spilling over into the commercial real estate market?
It is. It is. So if you look overall in space demand today, I actually would say the technology companies is the biggest gap. We see most of the demand today coming from financial services companies, law firms, professional service firms, and the technology companies are not leasing space at nearly the level that they were before during the pandemic, primarily driven by the large tech companies. However, in San Francisco, to your point, David, there are a number of AI companies, small startups and medium-sized companies that are taking space. I think the net absorption from those companies over the last year or 18 months has been about 2 to 3 million square feet. And also, interestingly, those workers are in the office, I think in many cases up to 5 days a week.
So that's sort of on the demand side for the office space. What on the supply side in terms of financing?
Yeah.
Where are we on available financing right now for commercial real estate?
Yeah. Well, before I get into the financing on the supply side, I would say new construction is obviously coming way down because today construction costs have elevated so much and rents haven't kept up. So it's very difficult to justify new construction because not only have hard costs gone up, but also the financing costs. So that's going to be helpful.
And that was Owen Thomas of Boston Properties with Wall Street Week's David Weston. And coming up tonight on Wall Street Week, we hear from Bank of America's CEO Brian Moynihan, former Fed Governor Dan Tarullo, and economist Laura Tyson. That's at 6 p.m. Eastern. Now, we do want to bring you an update, of course, on those outages that we've been seeing. This, of course, comes from the Microsoft 365 status on X, saying that we've completed our mitigation actions and our telemetry indicates that all previously impacted Microsoft 365 apps and services have recovered. They're entering a period of monitoring to ensure that impact is fully resolved. So the cleanup, of course, is underway.
Yeah, you still have Microsoft shares down about 0.3%, moderating those losses. CrowdStrike still down more than 8%, also moderating losses, however. And, you know, honestly, for CrowdStrike, you're looking at really only the worst day intraday since May.
Well, did you see that Dan Ives note saying that longer term, I mean, CrowdStrike is still a positive story, so.
Dan Ives says that he's still bullish on that.
He is still bullish.
Okay.
Surprise.
Yes.
Dan Ives is still bullish.
He's a very big bull, and he's been right.
Here's the thing, on critical infrastructure, what are you going to do, right? I mean, these are the companies that lay the pipelines for the internet, and it is what it is.
It is what it is, of course. The league table's hard to unseat there. Much more coverage coming up. This is Bloomberg.
Let's get to the trading diary, what you need to be watching today and next week. Today, we're going to hear from the Atlanta Fed president this afternoon. There you see Raphael Bostic. U.S. executives will head to China next week to meet with officials following the country's third plenum. That only happens twice a decade. On Tuesday, we get big tech earnings from Tesla and Google. And then on Wednesday, Israeli Prime Minister Benjamin Netanyahu will address the U.S. Congress. Thursday, we get U.S. GDP, followed by PCE, so inflation data on Friday.
All right, it's time now for ETF Friday, and I want to talk about equity ETFs because generally they account for about 30% of all exchange volume, but something interesting is happening this year. That share is well below the average, some days only hitting 14% or so. Let's get to Eric Balchunas right now. He is ETF analyst for Bloomberg Intelligence. Eric, what does this mean? Because I thought ETFs were taking over everything.
Yeah, no, I mean, if you're somebody worried about that, this is a good sign. In fact, I think it's a good sign. You don't want ETFs to trade, that much. If you look at as you said, the average is about 27%. So ETF volume would be 27%, and equity actual stocks would be the rest. Now it's down to 14% on some days. So it's been very low. The reason is simple. Nobody has any fear. Because a lot of that volume, a lot of the reason it goes up to sometimes 25, 30, even 40%, especially on crazy days, is that SPY, IWM, and the Qs are so liquid that institutions use them sort of like a moat around the portfolio. That's the first thing they use to tweak their position. So when there's fear, you see volume in SPY and the Qs and those big liquid ones really shoot up, and that shoots the whole number up. And so I think, if anything, this is just a sign that everybody's very calm and there's really no fear in the market. And also, I will say, the NVIDIA is a little bit of an outlier. That's trading more than SPY lately. So I do think the NVIDIA effect is part of this. People love trading that stock.
Well, to that point, of course, the Eric Balchunas view is that this means that there's not a lot of fear in this market. The Athanasio Serafakis view of Bloomberg Intelligence says that this means that people are just picking stocks more. I mean, how much water does that theory
That's
hold?
more fun, Eric.
Yeah.
Yeah, we're trying to give people hope. We're writing about the rise of passive, and it can be depressing for active managers. But no, the truth is stock picking is alive and well. There's also a lot of ETFs that do stock picking, and there's single stock ETFs now. But I think when you have a market like this where, there's opportunity to outperform, like if you had invested in NVIDIA, even overweighted a little, you're doing better. I think there are opportunities out there. And the fact that stock trading is alive and well is very important because ETFs are only going to work if the underlying is liquid. I mean, that's part of the secret sauce of why ETFs work well. So I love to see it. You want people picking stocks if you are an ETF fan.
Can you talk a little bit about the flows? Eric, anyone that watches you online shares your excitement about where the flows are actually going. And what did this week tell you?
Small caps finally woke up. IWM and RSP are both made the top 5. Those are the same trade. As my colleague and manager Gina Martin Adams puts it, the 493. The stocks that aren't the Magnificent Seven finally had a good run. So that would be equal weighting S&P, which is RSP. That's been hot. And also IWM. IWM actually traded more than the Qs, which hasn't happened since 2017. That was a couple days ago. Now, I saw IWM had a bad day, and I do wonder how long these rallies can last. A couple days of small caps. Can we get like a regime change for real? I'm skeptical. We've seen this movie before. It seems like large caps always take over after a couple weeks or months. We'll see, but certainly breadth in the market, we think it'll be really good for ETF flows overall because the money's still going into the large cap growth.
Right.
But if the other guys can, start catching fire, that's going to be good for basically everybody.
All right, Eric Balchunas of Bloomberg Intelligence. I'll see you on Monday because that's when ETF IQ is, every Monday at 12 p.m. Eastern. Now, coming up next week on Open Interest, Charles Myers of Signum Global, Ann Walsh of Guggenheim, and much more. This is Bloomberg.